You know, in this business of speculation, the market is never just numbers on a screen. It's human nature dressed up in ticks and bars. And before we go any further, let me say this ties right into something we talked about in the previous video on how to predict major financial moves, because understanding these phases of manipulation is really just another angle on reading the crowd before they know they're showing their hand. Now, traders like to believe the market is a fair arena where price reflects value. But anyone who has spent real time in the pits, or these days staring into the glow of a chart at dawn, knows better. The market moves in phases, almost like a 4-act play. And if you can read those phases early, you won't be chasing shadows, you'll be acting with purpose. After all, isn't that what every trader secretly wants? To stop reacting and start anticipating. The first phase I learned to respect was the accumulation phase. This is where the real operators move quietly. They don't show their size. They never announce their buying. They simply absorb shares while the public is looking the other way. The tape moves just enough to keep the inattentive bored. Now you might ask yourself, why would the market act so dull right before something significant? Because the big interests want it that way. They need time to get their positions without stirring the crowd. When you see steady buying on dips, tightening ranges, and the sort of quiet firmness that doesn't make headlines, you're usually watching the pros set the stage. And let me tell you something from experience, this is where patience separates the thinkers from the gamblers. A lot of traders want to see fireworks before committing, but the money is made in recognizing the spark before the flames. In fact, this is where your mindset matters more than your method. Wealth isn't built by chasing noise. It's built by understanding behavior. If you don't treat accumulation as the quiet beginning of a potential trend, you'll always be late to the move and early to the regret. Then comes the second phase, the markup. This is when the market finally wakes up. Prices begin rising with more conviction, and the public starts noticing. Volume picks up. Headlines turn optimistic. You might catch yourself wondering, is this the real move or just another tease? That's exactly how most people talk themselves out of an opportunity. The professionals, however, already laid their groundwork during accumulation. Now they simply ride the wave as the crowd begins doing the heavy lifting for them. You'll find that in this phase, confidence matters. Not the loud kind you see in promotional gurus online, but the steady confidence built on reading the market's early signs. If you trained your eyes properly, you recognize the rhythm and the momentum. You don't need predictions, you need interpretation. And this, by the way, ties back to what we covered in that earlier discussion about anticipating major financial shifts. The same principle applies here. The big moves show their roots long before the public sees the flower. Still, the markup phase can be dangerous for a new trader because it feels easy. The price keeps climbing, and every dip turns into another push. But don't be fooled. The challenge here isn't entering, it's holding. The human mind wants to grab profits too early. It wants certainty, and certainty doesn't exist in speculation, only probabilities. That's why I used to watch my own reactions more than the price itself. If the move was real, the market would confirm it by continuing to behave well on pullbacks and shakeouts. Now let's talk about the third phase, distribution. The same big interests who bought quietly now sell quietly. Funny how that works, isn't it? They never rush. They don't unload all at once. They feed supply into strong rallies, taking advantage of the public's optimism. And they do it in such a way that most folks don't see what's happening until the rug has already been pulled. Ask yourself this: how many times have you bought into a strong uptrend, only to watch it stall churn, and then suddenly reverse? That's distribution at work. The price stops making clean progress. Volume shows surges on rallies that don't go anywhere. The tape gets heavy. The smart money is handing the bag to anyone who still believes the trend can't end. And many traders, driven by the hope of squeezing out the last bit of profit, take that bag with both hands. In this phase, discipline matters more than excitement. Just as accumulation rewards patience, distribution rewards the trader who refuses to fall in love with a trend. when the character of the market changes. When price stops acting right, you need the honesty to step aside. Wealth is built by protecting your capital just as much as by increasing it. The trader with staying power is the trader who survives to catch the next cycle. And then comes the fourth and final phase, the markdown. This is where the decline becomes visible to everyone, though by then it's too late for most to react without pain. Selling intensifies, support levels crumble. The same people who were thrilled at the top are now afraid to look at their screens. How did this fall apart so fast? They ask, but it didn't fall apart fast. It fell apart during distribution. They just couldn't see it then. This phase is where emotional control becomes your best weapon. Fear is a powerful drug in the markets, and if you let it guide your actions, you'll exit late, re-enter worse, and destroy the very confidence you need to trade intelligently. The markdown for the prepared trader is not a disaster. It's information. It tells you the cycle has reset, and somewhere beneath the panic, a new accumulation will eventually begin. And if you think back to what we discussed earlier about anticipating major market turns, you'll notice the same idea repeating. Everything significant shows advance clues. The market doesn't whisper, it speaks clearly. You just have to listen without letting your hopes drown out the signal. Now the real question is, are you willing to train your eyes to recognize these phases when they're still subtle? Because that's the difference between chasing moves and positioning yourself ahead of them. That's the difference between reacting emotionally and acting deliberately. Accumulation begins when price action turns quiet, while volume subtly increases on down ticks, and most traders never notice this shift because the market deliberately disguises it as boredom. When the professionals accumulate, they make sure there's no excitement on the tape. They want the average trader to look away, to get impatient, to think nothing is happening. That quietness is not accidental, it's engineered. Whenever you see a market that just drifts sideways after a decline, barely stirring, you should start asking yourself whether the silence is genuine or manufactured. Because in speculation, quiet markets can be far more meaningful than loud ones. The nature of accumulation is subtle. It doesn't shout, it whispers. Think about how price behaves after a prolonged sell-off. Most amateurs expect a dramatic reversal, some grand moment where the chart suddenly explodes upward. But the big operators know better than to move that way. They accumulate by buying into weakness, not strength. They absorb supply when the public is still fearful. They buy on down ticks because that's where the liquidity is. They're not chasing price, they're harvesting it. It's a slow process, and if you don't have the patience to watch the small details, you'll miss the entire phase. When you examine the tape during accumulation, you'll often notice that declines begin losing their momentum. A down tick that once produced sharp follow through now barely travels. That's because someone is buying into the selling, but doing it quietly enough to avoid attention. Volume increases slightly, yet price doesn't fall much. That's not the behavior of a market collapsing, it's the behavior of a market being cushioned. And if you've ever wondered why some bottoms form in the most unremarkable manner, it's because bottoms aren't built on fireworks. They're built on steady hands buying what others discard. Another common feature is tightening price ranges. When volatility contracts after a decline, traders assume there's nothing to do. They get restless. They want action. But the professionals prefer this kind of environment because it allows them to absorb shares without competition. The question you should ask in these moments is simple. If the market were truly weak, why is it suddenly having trouble falling? Markets don't stop going down without a reason. Someone is taking the other side of all that fear-driven selling. This phase tests a trader's mindset as much as it tests their skill. Most people struggle with patience. They want confirmation before acting, and by the time they get the confirmation, the professionals are already positioned. Accumulation rewards the trader who can recognize strength disguised as weakness. It rewards the trader who studies behavior rather than headlines. And above all, it rewards the trader who understands that markets turn long before the crowd realizes it. Volume is the key to reading this stage properly. Not explosive volume, but meaningful volume. Slight increases during dips, repeated absorption near lows. You'll see candles with long wicks on the downside, showing that every attempt to push the price lower becomes an opportunity for strong hands to step in. Ask yourself why these wicks appear. Ask why the market refuses to break down further. That resistance to falling is often the footprint of accumulation. Inexperienced traders often confuse this phase with distribution because both can appear sideways, but the difference lies in how the market behaves around weakness. During distribution, rallies get sold. During accumulation, dips get bought. If a market repeatedly finds support on down, ticks and refuses to make new lows despite negative sentiment, you should pay attention. That's not random noise. It's intentional action by those who understand the long game. Another thing to watch is how news impacts price. During accumulation, bad news loses its sting. Headlines that once caused sharp drops now produce minor reactions. The market has already priced in most of the fear, and the professionals are taking advantage of that emotional exhaustion. When negative news stops driving price lower, it's usually a sign that sellers are running out of ammunition and buyers are quietly taking control. The emotional tone of the crowd also plays a role. At the beginning of accumulation, traders are often still anxious, expecting more downside. They hesitate to buy because the memory of the decline is fresh. But as price begins stabilizing, confidence remains low even though the real bottom may already be in place. This disconnect between emotion and price behavior is a hallmark of accumulation. The crowd doesn't believe in the recovery because it hasn't seen it yet. If you zoom out and think about the market's logic, accumulation makes perfect sense. The professionals want the best prices, and the best prices come when fear is high and demand is weak. They buy quietly so they don't inflate the price too soon. They buy on down, ticks because that's where liquidity rests. They are methodical because they can't risk alerting the public. If everyone starts buying at once, their advantage disappears. So they hide their intentions behind stillness. Your job as a trader is to recognize these footprints. You don't need predictions, you need observation. You need to study the behavior of price during quiet moments, not just explosive ones. You need to train your eyes to see the strength behind apparent weakness, the support beneath the surface, the buyers operating in the shadows. Because accumulation, when understood correctly, is not just a phase on the chart. It's the beginning of a potential opportunity that most traders overlook simply because it doesn't look dramatic. Reversals usually begin with subtle changes in volume, price harmony before the trend is obvious, and this is one of the most important truths a trader can internalize. Most people wait for a dramatic shift on the chart, a big candle or a sudden surge that announces the new direction. But by the time the move becomes loud enough for everyone to see, the smart money has already positioned itself quietly. Trends don't turn because of dramatic moments, they turn because the internal rhythm of the market changes, and those changes almost always appear first in the relationship between price and volume. When a trend is healthy, price and volume move together in a logical way. In an uptrend, higher highs are supported by strong volume, and pullbacks occur on lighter volume. In a downtrend, the opposite is true. Declines happen with conviction, while rallies feel weak, almost fragile. That's what harmony looks like. But before a reversal, this harmony breaks down in subtle ways. The tape stops behaving the way it should. Moves that once carried momentum now struggle. Volume shows up at the wrong times. A trend that once moved with confidence starts moving with hesitation. These small inconsistencies are what experienced operators watch for. They don't wait for the trend line break or the chart pattern confirmation because they know the earliest clues arrive long before those signals form. For example, imagine a market that has been rallying for weeks. Every advance has been supported by strong buying. Suddenly, you notice that new highs come on weaker volume. Then you see a pullback where the selling volume is stronger than usual. This shift may not be large enough to show up in a typical indicator, but if you're paying attention, you feel the character of the move changing. Price is still rising, but the energy behind it is fading. That's the first sign of a weakening trend. Not red candles, Not a sharp drop, just a quiet disruption in the harmony between price and volume. Ask yourself why volume is no longer confirming the strength of the move. Ask why buyers seem less enthusiastic. These questions guide your observation, and surprisingly, most traders never think to ask them. They trust what they see, price rising or falling, without examining the engine underneath. And the engine is everything. In a downtrend, the same principle applies. You'll see sharp declines with strong volume, and the rallies will be short-lived and weak. But as a reversal approaches, something feels different. Selling pressure dries up. Those long red candles don't appear as frequently. Suddenly, rallies begin showing more volume than the declines. You might notice a few days where price refuses to make new lows even though volume is elevated. That's accumulation taking place. The professionals are stepping in while the public is still focused on the direction of the old trend. The important part is that none of this looks dramatic in real time. It looks almost insignificant. A small shift here, a variation there, nothing that screams trend change. But that's the nature of reversals. They are born quietly. If they were obvious, there would be no advantage in recognizing them early. Trading is a study of nuance, not noise. Another telltale sign is the appearance of abnormal candles at unexpected times. Maybe you see a strong bullish candle appear after several days of controlled selling, but the news doesn't support it. Or perhaps a sharp selling bar appears in the middle of what should be strong bullish momentum. These anomalies are usually fueled by large traders adjusting their positions. The public doesn't notice because the price is still generally aligned with the old trend, but the internal pressure is shifting. Think of it like a storm forming long before the first drop of rain. The air thickens, the wind shifts, the sky darkens. Nature gives signals if you know how to read them. Markets work the same way. Before a reversal, the pressure changes beneath the surface. One of the most valuable habits a trader can develop is to look at volume and price together, not separately. Price shows intention, but volume shows conviction. When the two no longer agree, a turning point may be developing. It's like watching someone speak confidently while their body language shows hesitation. Which signal do you believe? The subtle one. The one that reveals the truth before the words catch up. This idea also ties into the psychological aspect of trading. A reversal doesn't just reflect a change in price. It reflects a change in crowd behavior. Early buyers test the waters. Early sellers take profits. Hesitation builds. Confidence falters. The crowd's enthusiasm slows, but it slows quietly at first. And those quiet shifts show up in the volume-price relationship before anything else. If you want to understand why professionals seem to anticipate turns while retail traders react late, this is the reason. The average trader waits for visible confirmation. The prepared trader watches for the loss of harmony. The trend doesn't need to reverse sharply to reveal its weakness. It reveals it through the slowing of momentum, the mismatched volume patterns, and the price movements that no longer make sense within the existing trend structure. When you notice these signs, you're seeing the earliest footprints of a potential reversal forming under the surface of the chart, long before the rest of the market realizes what's unfolding. Trend strength is confirmed by how the market behaves during pullbacks, not during peaks. And this is one of those truths traders nod at, but rarely practice with real conviction. Everyone loves the excitement of a strong push upward in a rally or a dramatic drop in a sell-off. Those big, obvious moments feel like confirmation, like proof that the trend is alive and well. But big moves can lie. Peaks can deceive. It's the quiet moments, the pauses, the pullbacks, the tests, that reveal the market's true character. If you want to know whether a trend is strong or weakening, don't stare at the tops. Look at the dips. In an uptrend, the market will naturally rise, then pull back, then rise again. That pattern is normal. But what matters is how the market behaves during those pullbacks. Strong trends show shallow retracements with controlled selling. Weak trends show deep, erratic declines that erase large chunks of progress. The amateurs tend to panic during pullbacks, believing the trend is dying. Professionals study the tone of those pullbacks with the same intensity a doctor studies a patient's pulse. They're not watching the big runs. They're watching how the market breathes. When an uptrend is healthy, the pullbacks are orderly. They come on lighter volume. The selling feels measured, almost gentle. Even when price dips, it does so reluctantly, as though the market doesn't truly want to give up ground. Support levels hold repeatedly. Buyers step in quickly. You'll notice that price often forms higher lows, even during retracements. This is the market telling you, quietly, that demand is still in control. Ask yourself why the sellers can't push the market deeper. Ask why every bit of weakness attracts fresh buying. These questions point you toward the truth of the trend's strength. Compare that with a weakening trend. In a fading uptrend, the pullbacks begin to stretch deeper. The selling volume increases. What used to be a calm, shallow dip starts looking more like a sharp rejection. Instead of higher lows, you get tests of old support, and sometimes those supports break. Buyers no longer rush in with confidence. The tape feels heavier. What changed? Not the peaks. The peaks might still look fine. It's the pullbacks that reveal the loss of conviction. They're longer, louder, messier. That's your first sign that the uptrend may be running out of steam. In a downtrend, the principles reverse, but the logic remains the same. You examine the rallies, not the breakdowns. When a downtrend is strong, the rallies up are weak, hesitant, low-volume affairs. They barely lift. They run out of momentum quickly. Sellers reappear with force. But when a downtrend begins losing strength, the rallies start climbing higher. They show more volume. They last longer than expected. The selling that follows becomes softer. If you only focus on how hard the price falls, you'll miss the quiet signs that the character of the trend is changing. Again, it's the pullbacks. The counter-trend moves that whisper the truth before the chart announces it. This approach requires a shift in mindset for many traders. People naturally fixate on tops and bottoms, the big flashy parts of the chart. But trends are not built or broken at the edges. They strengthen or weaken in the middle, in the small retracements, in the places where most traders get bored or impatient. This is why understanding the quality of pullbacks is far more useful than obsessing about the highs. The psychology behind this idea is powerful. In a strong trend, participants believe in the direction. Buyers in an uptrend are eager. Sellers in a downtrend are confident. This belief shows up in how aggressively the dominant side steps back in when the market pauses. If buyers truly control the market, they don't allow price to dip very far before reasserting themselves. And if sellers truly dominate, the rallies remain fragile. Once the tone shifts, once the dominant side stops responding with conviction, the trend is no longer the same even if the chart still looks intact at a glance. Another clue lies in volatility during pullbacks. A steady trend tends to show consistent volatility. But when you start seeing erratic swings during retracements, it may indicate uncertainty creeping into the market. You might see sharp dips followed by equally sharp bounces. This instability means the market is losing its directional confidence. The noise inside the pullback is revealing the weakening foundation of the trend, something the peaks themselves rarely show until it's too late. Watching pullbacks also helps you avoid one of the most common trading errors, buying at peaks or selling at troughs. Everyone wants to buy strength, but buying at the very peak of a rally is dangerous. You don't know if that peak represents sustainable demand or just the final gasp of an exhausted trend. If instead you study how the market behaves on the next pullback, you receive much more reliable information. You learn whether the trend is truly supported by strong hands or simply held up by late, emotional participants. This perspective also teaches patience. Many traders chase trends because they feel the fear of missing out. But the better approach is to let the market prove itself during a pullback. Let it show that the dominant side still has control. Let it reveal its strength through behavior rather than noise. When the pullback resolves cleanly and the trend resumes, you enter with more confidence because the market already confirmed its intentions. Understanding pullbacks doesn't mean predicting them perfectly. It means learning to read their character. Slow, steady, shallow pullbacks suggest continuation. Deep, aggressive, high-volume pullbacks suggest vulnerability. When you begin to interpret these signs with clarity, your entire approach to trend trading changes. You become more selective, more patient, more strategic. Instead of reacting to the excitement of the peaks, you respond to the authenticity of the pauses. Markdown accelerates once support levels break and trapped traders rush to exit. And this simple idea explains more market collapses than any complicated indicator ever has. Markets don't fall apart because people suddenly become pessimistic. They fall apart because the structural supports that held traders' confidence together finally give way. Those supports aren't just lines on a chart. They represent belief, hope, conviction, and the illusion of control. When they snap, they take human emotion with them. And emotion, when panicked, creates the fastest price movement a trader will ever see. Think of support as a psychological flaw. During a decline, traders tell themselves, if price can just hold here, the trend might still recover. They anchor their decisions around a level. They place stops beneath it. They justify holding losses as long as that line remains intact. As long as support holds, fear stays contained. But once that level breaks, the crowd loses its reference point. Suddenly, the decline feels deeper than numbers. It feels personal. This is where the panic rush begins. When support breaks decisively, trapped traders act almost simultaneously. Their stop losses trigger. Their broker warnings fire. Their hope evaporates. The break forces them to admit something they've been avoiding. The trend didn't just dip, it reversed. This realization often happens not slowly, but in a single moment. And these moments can be marked by a surge in volume and a swift drop in price, because the same group that was confidently waiting for a bounce is now desperate to get out at any price. Ask yourself how often you've seen a chart drop sharply after a clean support break. It's not a coincidence. It's just human nature displayed through price. What makes markdown acceleration so powerful is that most traders don't prepare for it emotionally. During the decline leading up to the support level, they still feel some control. They believe they're only down temporarily. They convince themselves that the market will respect the same levels it respected before. They cling to the idea that history will repeat as long as the line on the chart stays untouched. But the market doesn't bend to beliefs. It bends beliefs to reality. And when the reality shows itself, the response is rarely rational. One of the earliest signs of an upcoming breakdown is how price behaves as it approaches support. In a weakening market, rallies become smaller and shorter. Selling pressure intensifies. You start seeing heavy volume on down days and lighter volume on up days. A price begins creeping toward support with a tone of inevitability. It doesn't bounce cleanly like it used to. It tests and retests the level, each time with less energy. This is the market telling you something long before the actual break. Confidence is eroding. Once the break finally happens, the acceleration isn't just technical, it's psychological. A trader holding a losing position doesn't think in terms of probabilities anymore. They think in terms of loss avoidance. They want out, and when thousands think the same thought at the same time, liquidity evaporates. Bids thin out. The price drops faster than seems reasonable. This is why markdown phases often contain the largest candles in the entire market cycle. Fear compresses time. What should take days can happen in hours. Professional traders understand this dynamic well. They know that during markdowns, the crowd will sell aggressively, and liquidity will be abundant on the way down. Many of them participate early in the breakdown, not because they hate the asset, but because they know panic will fuel continuation. They know the crowd will feed the move. They know trapped traders become forced sellers. It's not malicious. It's simply how the market transfers wealth from the emotional to the disciplined. Another powerful characteristic of markdown acceleration is the lack of meaningful bounces. Once the support is broken, small rallies tend to be weak, almost half-hearted. Buyers who previously defended levels are now absent. They're scared, confused, or already liquidated. Sellers dominate every uptick. Price might retrace slightly, but each bounce is sold quickly, and each rally feels smaller than the last. Ask yourself why this happens. Why do rallies suddenly lose their power? Because the buyers who gave price strength earlier are no longer confident. They lost their anchor. The breakdown shattered their expectations. During markdown, volume often spikes because panic creates turnover. Every share being sold must be bought by someone, but buyers during this stage are usually opportunists. Professionals, short sellers, or traders positioning for the next phase. They are not emotional buyers, they're strategic. This shift in who is participating explains why the tone of the market becomes more violent. Emotional traders exit, strategic traders act, and price reflects the imbalance. The most ironic part of markdown accelerations is that the public rarely sees them coming, even though the signs often appear long beforehand. The weakening rallies, the heavier selling, the inability to reclaim previous highs, the deteriorating volume structure, these clues show up well before the official breakdown. But most traders only respond to dramatic signals, not quiet ones. They wait until the support break is undeniable, and by then, the move is already in motion. If you've ever found yourself selling during one of these fast drops, you know how overwhelming it feels. There's no time to think, no patience to analyze, just urgency. And that urgency is exactly what fuels the acceleration.